Hello everyone and welcome back to my channel. Today we are going to talk about ICT Power of 3. Specifically, I want to cover how we want to trade real distribution. But before we start, don't forget to subscribe to my channel, hit the like button, and if by the end of this video you are going to have any questions, you can leave these questions in the comment section or just send me direct message in Instagram or Twitter. Okay, let's start. So, Power of 3. We also know them as accumulation, manipulation, distribution. Sometimes you can see ICT Power of 3 or you will see ICT AMD. So it's pretty similar idea. ICT Power of 3 is exactly the same as ICT AMD. Accumulation, manipulation, and distribution. Accumulation happens at the open of candle. Manipulation is usually the low or high of candle, and distribution, also known as range expansion, is low resistance liquidity run after manipulation. Okay, accumulation is where large institutional players, big banks, so we all know them as smart money, accumulate positions to set up framework for distribution phase. During this phase, price action tends to be, it kind of looks like range bound with low volatility, relatively small price movements, so consolidation. We can see accumulation, also we can say consolidation above or below or near opening price. In accumulation phase, we see consolidation where a lot of liquidity is generated, and then we see fake move to clear all liquidity and then smart money reversal. Okay, after accumulation, so we can anticipate manipulation. So after smart money accumulated their position, they move into manipulation phase. Manipulation is where smart money engineers price moves to create liquidity. They drive the price to stop loss levels to create liquidity. Basically, we know that they're trying to take retail stops. They do this by running price above or below consolidation, above or below accumulation phase. Basically, manipulation is where fake move occurs. As I said, smart money forces retail traders to think that price is breaking up or breaking down and then quickly reverse and expand on the opposite direction. So after this, of course, we can anticipate smart money reversal. But how can we use standard deviation projection to anticipate possible manipulated move down or up? So anticipate manipulation. Okay, during accumulation, the lowest, highest, obvious, and the most visible measured range, so from here to here. So basically, we're trying to find the most obvious and visible range, ideally last move up or last move down inside consolidation, and we want to project from this low to this high, from high to low, depends on the direction where we can anticipate possible manipulation. From this low to this high, I want to project move all the way down, and most of the time you will notice that manipulation usually ends at the range between 2 and 2.5 standard deviation. For example, we can see obvious accumulation right here, consolidation, right? We're trying to find the most obvious and visible leg, ideally last leg, from low to high. Then we want to project, and we can see that manipulation ends near the range between 2 and 2.5, and after this we got range expansion. As I said, manipulation usually occurs between 2 and 2.5 standard deviation range of consolidation leg projection. Right here, right here. How do I know when this manipulation phase has finished? We always must think in terms of market maker model. From our video where I explained how we want to treat market maker model, we should know that market maker model starts from high time frame level. Then we're going to switch on lower time frame. We should find lower time frame change in the state of delivery, lower time frame market structure shift, and we can confirm this by smart SMT divergence. So ideally within 2 and 2.5 standard deviation range. What do I mean by this? This means that I always want, not always, but I prefer to see the range between 2 and 2.5 standard deviation range near higher time frame level. And in order to confirm transition from one program to another one, for example, from buy program to sell program, from sell program to buy program, we must have high time frame level. Then we must have lower time frame change in the state of delivery order block, real order block, and lower time frame market structure shift. And only after this, I can draw manipulation leg projection. So I will use the very last leg before reversal confirmed by change in the state of delivery and market structure shift. This leg will be my manipulation leg, and at this range, preferably must be within 2 and 2.5 standard deviation. Like this. The most obvious invisible leg inside consolidation, we projected this move down 2 and 2.5 standard deviation, then reversal, market structure shift change in the state of delivery. Move right here is the most obvious invisible leg right here, after we got manipulated move. From this high to this low, we got manipulation. Manipulation leg projection to offer distribution. Same idea here. We got consolidation, leg, the range between 2 and 2.5 standard deviation, then reversal, manipulation ends right here. Market structure shift change in the state of delivery, manipulation leg, move down. Okay, here's example how we want to actually find accumulation, manipulation, distribution. So we got from previous slide, we know that we want to find accumulation, obvious leg, invisible leg right here from low to high. We got projected move right here, the range between 2 and 2.5 standard deviation. After this, we got daily fair value gap right here. This daily fair value gap right inside the 2 and 2.5 standard deviation projection. So we got manipulation. We wait for confirmation by changing the state of delivery and market structure shift. After this, I want to draw manipulation, and here we go, we got 4 standard deviation. Okay, can I trade the move from consolidation? Yes, I can trade the move from consolidation to high time frame level or aim for 2 and 2.5 standard deviation range. What is the best entry for this? The best entry will be change in the state of delivery order block that was formed near 50% of this consolidation. We may see that price may break below or above consolidation and immediately back to this range. Most of the time we see this quick retracement back to the range to detect the change in the state of delivery that was formed near 50% of this accumulation consolidation. But it doesn't mean we need to wait for the break above or below consolidation to retest this order block. This retest might be right inside this consolidation. So this is in Q chart from 3 weeks ago, if not mistaken. So we got accumulation. I measured from this high to this low, I found 50%. We got order block inside this 50%. So this order block was from near 50%. At the open, we got quick move down to this order block and then move up. So I measured this move up to the range between 2 and 2.5 standard deviation. Yes, I can place my entry at this order block with stop below consolidation low and aim for this range between 2 and 2.5 standard deviation or high time frame level. So here we go, we got move down and we got perfect real distribution right here. Okay, distribution. The final phase of power of trade is distribution, is where smart money distributes their positions to retail traders and investors who typically late to recognize the change in the market order flow. During this phase, we expect price to expand in the opposite direction of manipulation phase. So, quick tip for you guys: real distribution is entire leg of market maker buy model or sell model. Understanding of real distribution will help you to trade entire move inside buy or sell program. Well, what I mean by this is that all you need just one entry, just wait for your target of market maker buy model or sell model. Okay, just quick reminder how candles looks like. So on the first example, we got up close candle. Second example, we got down close candle. We can see open of this candle, then move down below consolidation, accumulation low, formation of low. The candle, this is where we got manipulation. After this, we want to wait for range expansion. In other words, distribution. It will offer the high of the candle and then closure. Same idea for a down close candle. We got open, run above consolidation high, formation of high of this candle, manipulation. So this run above consolidation offered manipulation. After this, we got range expansion, we got distribution to offer the closure of the candle and low this candle. Relation of height frame and power of 3. Exactly as explained in my market maker model video, we want to use height frame PD rate to anticipate lower time frame market maker model. Same idea here, exactly same idea. For example, if I want to understand how weekly candle forms, we must wait for open of this candle. If we can see open like this, with quick move down below consolidation low, we can say we got manipulation down right here, and then range expansion to form the high of this candle and closure. So basically this, just one candle, weekly candle, looks like this on 1 hour chart. Exactly that we can use actually when we're trying to find intraday bias. We can use 4 hour candle, or we can use 1 hour candle and then switch on 5-minute chart, on 1-minute chart to anticipate possible consolidation. Then we can see possible trade from consolidation to manipulation, then distribution. Ideally, real distribution. Okay. Accumulation, manipulation, and distribution phases. This is all occurs within just one single candle. This means 4-hour candle like this will look like this on 5-minute chart. And this applies to any power of 3 candles. So here's indicators that you can use on the trading view. For example, you will see this candle. If you want to open 5-minute chart and just choose 4-hour as your high time frame, so you will see this candle, and this candle looks like this on lower time frame. We got open, then manipulation to form the low of the candle, then distribution, high, closure. Okay, ideal distribution. Ideal distribution must be considered only within market structure. As in intraday traders, we use a real distribution concept to form daily and 4-hour candles. And I would say 1 hour as well, 1 hour candle as well. This is why I often use 5 and 5-minute as high probability real distribution setup on these time frames. Once I found manipulation, we want to consider is as intermediate term high or intermediate term low. So consolidation, move down, I want to consider this move down right here as intermediate term low formation. As we remember from our market maker model video, intermediate term high is the high that has short term high on the left and short term high on the right side of intermediate term high. And intermediate term low is the low that has short term low on the left side of intermediate term low and short term low on the right side of intermediate term low. Basically, intermediate term high and intermediate term low is high or low of manipulation move. But how we want to trade real distribution? To trade real distribution, we must wait for formation of short-term high and short-term low on the right side of intermediate term high and intermediate term low. This slide is important. You can take screenshots or make notes right now. This means that we want to wait for the very first retracement after we got confirmed manipulation move. Once again, we anticipate to see formation of manipulation leg at the range between 2 and 2.5 standard deviation of consolidation leg. This leg must be inside high time frame level. For example, we got consolidation, we got visible leg and obvious leg right here. From this low to this high, we projected move all the way down. We got range between 2 and 2.5. This range inside high time frame level, perfect. We were trying to find short-term low, intermediate-term low, and short-term low. As we know already, intermediate-term low is the low that has short-term low on the left side of intermediate-term low and on the right side of intermediate-term low. This means we must have short-term low right here and right here. So we're trying to find short-term low first on the left side. After we got manipulation, we want to consider this as intermediate-term low. And next, move up from this high time frame level and retracement. The very first retracement is going to form short-term low on the right side of intermediate-term low. But once again, we don't want to focus only on 2 and 2.5 standard deviation levels. No. Higher frame level must be first point where we can consider possible smart money reversal. Use the range between 2 and 2.5 standard deviation only as additional confirmation, not as a key factor for reversal. So now we have short-term low on the left side of intermediate-term low and on the right side of intermediate-term low. This yield distribution will be the very first fair value gap after short-term low or short-term high that was formed on the right side of intermediate-term low, intermediate-term high. Yes, most of the time you will notice that after fair value gap, after short-term low was formed, the price keep going higher or lower depends on the direction, leaving this fair value gap unfilled, basically open. I usually call this as fake distribution, which traps many traders because they consider this as a breakaway gap, and from ICT lessons we remember that breakaway gap usually must stay open to consider as additional confirmation that we are basically entered market maker buy model or sell model. So usually people trying to place their stop above breakaway gap or below breakaway gap, depends on the direction. Okay, next question that I usually get right here is how to find short-term high, short-term low. It's not easy. Sometimes it's kind of tricky, but here's the tip. To find short-term high and short-term low that was formed on the right side of intermediate-term high, intermediate-term low, you must consider candlestick structure. What do I mean by this? Looking at this piece of chart, we can see I actually zoom in for you guys. Intermediate-term low right here, and I call this short-term low. Yeah, it's kind of not obvious right now, but we must think in terms of candlestick structure. This move right here looks like this. So basically, with these red lines, I showed you how this candles actually looks like if I want to use just lines. So intermediate-term low, intermediate-term low, short-term low, short-term low. Much more obvious, right? But sometimes it's still tricky to find this short-term low, short-term high. What can actually help us? Low time frame. Just one simple answer, low time frame. So here's 5-minute chart. It was on NQ, maybe 1 month ago. So this short-term low looks like this on 30-second chart, right here. I guess you agree right now that it's super obvious short-term low right here, no questions anymore. But on 5-minute chart, this short-term low looks like this. Just train your eyes to see this price movements in terms of candlestick structure. So once again, this move right here it looks like this on 5-minute chart. On 30-second chart, it looks like this. Keep in mind that key factor time. Time is always much more important than price. We should wait for the proper time when real distribution becomes a high probability setup. Usually the first run is a fake run due to wrong time. When the time is correct and we have proper market structure, we will see a real move, which is real distribution. You will often see manipulation around 1:30, 2:30 a.m., 3:30 a.m., 6:30 a.m., and 9:30 a.m. So why I highlight 1:30 and 2:30 with red color? Because I usually call this as early manipulation. The fair value gap that we want to consider as real distribution fair value gap usually forms between 2:30 to 2:45. I call this also as early fair value gap, so early possible real distribution. Then 3:45, 4:30. After we got manipulation between 3 and 3:30, 7, 8:15 a.m., 9:40, 10:40. 9:45, 10:45 a.m. after we got manipulation between 9 and 9:30 a.m. Lunch consolidation usually between 1:30 and 1:45 a.m. So here's an example on YM. We can see we got accumulation, obvious invisible leg right here. I want to project my move down, range between 2 and 2.5. usually possible end of manipulation move. We also see that YM entered daily fair value gap, daily bullish fair value gap. Here we can see what? Intermediate term low, short term low. Once again, we want to find this in terms of market structure. And lower time frame, it's going to be super obvious move right here. So, in the very first fair value gap after we got short-term low on the right side of intermediate-term low is going to be real distribution fair value gap. Here we go. Perfect. One more example. Not super obvious, but still perfect example for us. You should keep in mind we are not going to always get perfect A plus setups. No. Here's an example. We got pretty much consolidation right here. Then we finally broke below consolidation and entered higher from level for our order block. We can see intermediate term low, short term low, and the very first fair value gap after short term low is going to be real distribution. I'm going to enter right here, place my stop below short term low, and just keep my trade to my target. Another example. I actually show how we want to trade this consolidation. Then we actually can find the two trades inside this price movements right here. See, we got consolidation, order block that was formed near consolidation, 50% of this consolidation, retracement to this order block, move up. There's a 1 hour bearish fair value gap and range between 2 and 2.5 standard deviation. Perfect. It formed intermediate term high. Right after this, it formed short term high. Perfect. The very first fair value gap after we got short term high is right here. That is going to be a real distribution fair value gap, and that's going to be a real move to offer distribution, range expansion. One more example. Consolidation. Break above consolidation, we entered bearish 4 hour fair value gap, intermediate term high, short term high, the very first fair value gap after short term high. Here we go, real distribution. Okay, how we want to place our stop losses? We place stop loss above short term high when we have pretty big range between intermediate term high and short term high that was formed on the right side of intermediate term high. What do I mean by pretty big range? We have distance between intermediate term high and short term high. And we want to place stop loss above intermediate term high when short term high was formed immediately after intermediate term high. Candlestick structure, remember this. Same idea with long trade. We want to place stop loss below short term low when we have pretty big range between intermediate term low and short term low. This means we have distance between intermediate term low and short term low. And I want to place my stop below intermediate term low when short term low was formed immediately after intermediate term low. Like this, we have distance. I want to enter this fair value gap, my stop below short term low, and here we go, real distribution. Examples. So, fair value gap, we got intermediate term low, short term low was formed immediately after intermediate term low. Then I want to enter this fair value gap, stop loss below intermediate term low. For my target, I can actually take partial at my consolidation high and just leave another partial to our higher time frame level. Because since we trade market maker model at this point, real distribution offers market maker model setup, we want to target higher time frame level, obviously, to anticipate another smart money reversal. One more example. We got intermediate term low, short term low. So actually we have distance. It wasn't formed immediately after intermediate term low, right? So fair value gap, the very first fair value gap after short term low is going to be my entry. So I'm going to enter right here. My stop loss is going to be below short term low, and I'm going to target for projection level. We know how we want to use projections level from my market maker model video. We can take partial at consolidation high as well. Partial, I'm not going to say we are going to target this level, but partial, yes, is fine. One more example. We got intermediate term low, short term low immediately after intermediate term low. Perfect. The very first fair value gap after we got short term low, entry, stop loss below intermediate term low. Once again, why? Because short term low was formed right after intermediate term low. At this point, I must place my stop below intermediate term low. One more example. That's actually Tesla. I just want to show you that it works actually everywhere. We got consolidation, move up to the 50% of weekly order block, intermediate term high, short term high, that was formed immediately after intermediate term high. Well, the very first fair value gap is right here. I'm going to place my limit order right here with stop above intermediate term high. Perfect. One more example. Some cryptos. Yeah, it's crypto actually. We got 50% of daily order block, intermediate term low, some sort of distance between intermediate term low and short term low. We got equal lows right here, so short term low was formed only right here. We can see that the very first fair value gap of short term low was kind of open, never was tested. Price simply ran away from this level, but failed to take this fair value gap, right? 15-minute fair value gap. What does it mean? We want to see retracement all the way down to this fair value gap. Now I want to place my limit order right here with stop below short-term low, and my target right now is going to be this 15-minute fair value gap. One more example. We entered bullish for our fair value gap. It formed intermediate term low and short-term low. Again, some sort of distance. Well, the very first fair value gap after the short-term low was right here. Okay, I'm going to enter right here with stop below short-term low, and I'm going to target, for example, take partial at consolidation high. So I don't have more data right here, and I'm not sure what happened next. But partial taken. It was CPI last month, so we can see consolidation then move all the way up. It formed intermediate term high. Perfect. Short-term high right here. The very first fair value gap after short-term high is going to be till distribution. But since short-term high was formed immediately after intermediate term high, I'm going to enter this fair value gap with stop loss above intermediate term high. And for example, I would say take profit right here at this consolidation low because it's pretty huge range. Maybe you want to ask me if I could consider this as short-term high. In hindsight, of course, I could consider this as short-term high, and this fair value gap right here was the very first fair value gap after we got short-term high. Yes, I could enter here as well. It's not a problem. Okay, here's example. So it's example from my pre-market plans that I usually post around 9 a.m. So let's read this. I'm going to read for NQ. It was July 19. Okay, July 19. Yes, exactly. We don't have any news. We can see. I'm going to read for NQ. NQ offered another amazing move down yesterday, where we saw immediate balance of weekly fair value gap, and currently stuck near weekly change in the state of delivery. Okay, perfect. Definitely, weekly objective was met and was met perfect. Next, I'm going to read what I could expect once market opens. So at the open, if I can see reaction from 15-minute bearish fair value gap that was formed today at 2:30 a.m., I will wait for formation of 5-minute change in the state of delivery to place short with my partial level at equal lows, and final target is going to be daily sell side liquidity. Okay, let's look what happened actually. As you can see, it was posted at 8:44 a.m. before market open. So this is July 19, so we got manipulation. This small fair value gap that was formed at what time? 2:30 a.m. Right here. Since short-term high was formed immediately after intermediate-term high, of course, I'm going to consider this short trade with my stop loss above London high, intermediate-term high. And as you can see, it never ever broke above this intermediate-term high. Perfect. So this yield distribution setup was textbook right here. We got partial at these equal lows. We got final target right here. Exactly what I stated in my pre-market plan. In validation of this short setup will be above London high. Why? Because this London high is intermediate-term high. Here we go. Perfect trade. Okay, to prevent upcoming questions, yes, you can trade this on any time frame. You don't need to look for only, for example, 15-minute chart, 5-minute chart, 1-hour chart. This setup works even on 10-second chart. Manipulation can also happen at times other than those I mentioned earlier. So I mentioned manipulation 2 to 30 a.m. It doesn't mean we need to wait for this time specifically. No, this time, this is where high probability deal distribution occurs, but it doesn't mean like you will not find the setup, for example, during PM session or lunch. Remember, the high term level is a key to start market maker model. And we want to trade real distribution to just have one entry for this entire market maker model. Personally, I like to use a 15-minute chart and 1-hour chart to confirm my intraday bias. I can trade the entire move of market maker buy model or sell model using 15-minute real distribution for a value gap only. So just as you know me, I'm very picky with my trades, and I usually trade just once a day. So I usually try to find 5 or 15-minute real distribution and enter this. So that's why I have like 70, 100 just points trades. Just one trade and I'm done for today. Okay, just want to show you one of my backtest sessions. So here's just one example. As you can see, I'm trying to set balance. So just trying to pick a random day on NQ. Since I trade NQ, I backtested this. So I pick April, choose just random time. Okay. So now I have the chart. So of course I want to start from higher time frame. Not going to just randomly pick any accumulation, any manipulation, and any distribution. Now I want to start my analysis from higher time frame, and let's see what actually market wants to offer us. We have buy side liquidity. I switch on 1-hour chart right now. What I'm doing right now, I want to highlight, since we got pretty huge expansion, I want to highlight equilibrium of previous day range. How I want to measure equilibrium of previous day range, I want to measure from midnight to midnight. This means I want to find midnight and midnight, I want to find the low and high inside this range. I don't use daily candle for this. I use daily candle to find high and low. Previous day high, previous day low. But for my equilibrium of previous day range, I use the range between midnight and midnight, low and high. This is what I'm trying to highlight here. Perfect. Here's this one is equilibrium of previous day range. And I see that this 6 a.m. actually already, we never price never ever trace to this level. So I can consider this level as my possible daily target. Let's see. So why I'm actually trying to ignore these trades? Because we're still below my high time level. I cannot place like just random short to this equilibrium previous range without taking high time level. I'm waiting here. We can see that price actually retraced down, then back to this range, back to the top of this range. Okay, then back down to discount. So I can consider this as consolidation, perfect consolidation. What happened right here? We got moved to buy side liquidity, high time frame buy side liquidity. Perfect. What happened next? Here I'm trying to figure out if I can use this change in the state of delivery right now at this moment to consider possible short setup. We can see that we entered daily fair value gap as well. Yes, I can consider right now this as 5-minute change in the state of delivery. Well, perfect. So what I can see here, it formed intermediate term high, it formed short term high right here, right? short-term high was formed right after intermediate-term high. So I can place my stop above intermediate-term high. So we got two high time frame levels, which is for our buy-side liquidity daily fair value gap. The very first fair value gap after we got short-term high was right here. This means I want to enter right here with stop above intermediate-term high and target at equilibrium of previous range. Let me see what I actually did. I recorded this long time ago, so I don't actually remember. I did this right. Perfect. So once again, short-term high is this candle, not this candle, this candle. The very next candle after intermediate-term high. I just move this. Changing the state of delivery. Here trying to measure how many points actually this move. It's almost 300 points. I was like, what? Obviously, I don't want to target this. Since this is already like 1 p.m., of course, I'm not going to target this. Here I'm trying to find the very first obvious liquidity level. Right here. Here I decided to move my stop at 50% of this 5-minute change in the state of delivery. Maybe that's kind of stupid. What I did actually right here, my stop must be in above intermediate-term high, but let's see. I'm trying to place my order. Then I see like quick delivery. I was like, this means there is chance to see equilibrium previous range faster than I expected. So I decided to move to this equal lows right here. It's already like 150 points straight. Okay, I moved to break even, especially, okay, my first TP was reached right here. I don't know how to take partials right here, so I moved basically to break even. So this trade already up 100 points. Here was stupid to do because I didn't see the time. It was almost 4 p.m. So I was needed to take my partial at this, not partial, take my profit at this equal low. So I decided to move my target to equilibrium of previous range. So my 150 points was reached. So I move in profit. My stop actually right now in 50 points profit. Perfect. Then I move my stop right here above this short-term buy-side liquidity. Stopped out right here, and from my stop actually price went all the way down to my TP. It's okay. Perfect trade. This is how you want to do this. Once again, you must do this with must start with high time frame level, then change in the state of delivery, then you must find intermediate-term high, intermediate-term low, short-term high, short-term low, right? And the very first fair value gap after short-term high or short-term low is going to be till distribution fair value gap. Okay, guys. If you are going to have any questions after watching this video, you can leave the comment or send me direct message. So I hope I explained this in pretty clearly. So I hope you are not going to have any questions, and that's pretty solid setup. So it works 9 of 10 times on 5, 15, and 1 hour chart. So it 5-minute chart and 15-minute chart. It's kind of high probability setup always, especially during AM session. So I like it. I like it so much. You can backtest this, share your results with me. So thank you guys for watching, and I will see you in the next video. Bye bye.